Good afternoon, everyone, and welcome to our webinar. Let's start with coffee can. If you look at this month's performance, it's been down 7% versus Nifty being down 6%. From that perspective, it was a difficult month for the coffee can. The key top performers were PB Fintech, ICICI Bank, and HDFC. However, the draggers, which were in double digits, were Avenue, Bajaj Auto, and Havells. If we were to look at the 6 months performance, it's up about 7.5% versus 8% broader markets. So if we move to GNC. So if we look at GNC for the month, it was down about 6.7% versus 6.4% in terms of BSE 500. So the deviation was very marginal at about 0.3%. In terms of the key top performers were CDSL, Aegis Logistic, and Federal Bank. So Aegis Logistic was bought just about recently. And in fact, if you look at the calendar year also, it's done very well at about 67%. The bottom performance was from Chola, Supreme Industries, and AU Small Finance Bank. If we move to emerging giants. So emerging giants for the month has been down 0.9% versus 6.4% negative for BSE 500. So to that extent, if we do it from a relative perspective, it's been a good month for emerging giants. The top performers were Tips Industries, Prudent, which we recently added, and Mastech. In terms of the bottom performance was Venus, VIP Industries, and Rosari Biotech. If we move on to 10x. So 10x for the month is down about 6.5%. But if you look at relative to the benchmark, it's more or less in line with the fall in the benchmark. The top performers in the month of October were Orchid Pharma, Aegis Logistic, and Lupin. And if you look at the bottom performance, it was Chola, Go Fashion, and AU Small Finance Bank. Let's move on to the newsletter which we wrote for this month. So it's an interesting topic on which we wrote. So essentially what we are saying is that from the next 5-year perspective, India, if it has to grow GDP on a sustainable basis, then obviously manufacturing is a key. So let me just share this interesting slide with you. So what this slide tells you is that if you look at the golden phases of GDP growth across Southeast Asia, countries like Thailand, China, Indonesia, Vietnam. If you look at the golden periods of GDP growth, one of the pillars for the GDP growth has been the rising share of manufacturing. So if you look at Thailand, the share of manufacturing during the start of the growth phase was at about 22%. But when the growth phase ended, it increased to about 28%. For China, it started off from 9% and it ended up to about 32%. Likewise, for Indonesia and Vietnam as well, there was a significant increase in terms of share of manufacturing. Now, the reason why this is relevant from the India perspective is because if you look at the drivers, if you go back to the earlier slide, please. So if you look at from an India perspective as well, this makes a lot of sense. The reason we are saying so is because if you look at developed countries, therein the share of services in the GDP growth typically is higher because of higher per capita income. But if you look at the developing economies, there it's very difficult to fathom that services will consistently give you GDP growth, because the per capita income in developing countries is far lower as compared to the per capita in developed countries. So, for India to sort of reach a $10 trillion dollar GDP country, obviously it's very important that manufacturing clearly plays a important role. And if you look at some of the behavioral patterns of the government, which we'll address in the upcoming slides, you'll see that we are in that direction where the government seems to be in a mood to push manufacturing. Yes. So this slide talks about what were the key government initiatives that were taken by China to ensure that manufacturing as a percentage of GDP significantly contributes to the overall GDP growth. So if you look at on the left-hand side of the slide, you will see several enablers. For instance, they initiated a lot of reforms on the trade and investment side. They came up with significant SEZ laws which attracted a lot of FDI money. The government sort of emphasized a lot in terms of infrastructure development, in terms of spending. They used their currency as well as an export subsidy tool. And lastly, but very importantly, they designed extremely market-friendly labor laws. In fact, I would recommend you to read our newsletter, wherein we've elaborated a lot in terms of detailing. And if you look at the charts on the right-hand side, you can clearly see that a few of these enablers have resulted in significant FDI inflows. And alongside that, you can also see that exports sort of significantly contributed to the overall GDP growth. So net, what the Chinese government tried to do was use China as a manufacturing hub of the globe, which in fact started boosting up their GDP growth. So if we move on to the next slide. So very similar to that template, we are also trying to sort of replicate that template. And if you look at the top 6 states by GDP contribution, you can already see that the main driver of it is manufacturing. So if you look at the top 6 states by GDP contribution and growth, which is Maharashtra, Gujarat, Tamil Nadu, Karnataka, UP, and West Bengal. If you can clearly see from the chart below that the main driver of the GDP growth for these 6 states has been manufacturing. So what we are trying to highlight is that this is the same template which will take us to the $10 trillion dollar mark in terms of GDP. And the only difference should be that as of now, there are just about 6 states which are contributing, but you need more and more states to sort of replicate this template, and which is what we are highlighting should be the case over the next 10 years. Let's move on to the next slide. Yeah. So what are the steps that the government is taking in order to ensure that our manufacturing also sort of starts firing? So the most important announcements which has been done has been on the production-linked incentive scheme. So there are now almost 14 sectors which are eligible to claim a production-linked incentive, and this incentive is very lucrative, because what it does is that it acts as a subsidy tool for the manufacturer to invest, and the incentive is also fairly generous. So almost 2 to 5% of your revenue is given as incentives depending upon the revenue milestones you reach, and that is the reason why we are seeing significant investments across the several sectors which have been highlighted. And the good part is that every year the government keeps on adding new and new sectors to this particular list. So maybe in the next 5 years, you could actually see more than 30 subsectors within the manufacturing bucket, which will be qualified to be given as a PLI. Let's move on. If you look at our portfolios as well across market cap buckets, we are overweight on manufacturing as a theme. So if you look at emerging giants, if you look at coffee can, if you look at good and clean, we are very much bullish on the manufacturing as a theme. BFSI is also a part of manufacturing, because if manufacturing capex has to be done, it has to be fueled by BFSI. So net, what we're trying to highlight is that in the event manufacturing as a vertical fires, then clearly our portfolios can also sort of meaningfully take benefit of that underlying theme. So I would recommend you all to sort of have a read through our newsletter. It's a very interesting document wherein we've given a lot of data and also compared our emerging market neighbors, so that you can also get a sense in terms of why manufacturing can be a big enabler towards our target of achieving 10 trillion economy. Yeah, Tulok, you can take it from here.
Yeah, thank you, Bhargav, and a very insightful sort of perspective on how manufacturing will drive. Particularly, was very enthused on the top six states. I think so. These are some information that a lot of us learn when we go into deeper. So with that, I think so. Moving from economy to what's happening around the world, I'll just take a quick overview on the macro perspective. As we know, the U.S. election, the most talked about event for the year, is behind us. The good news here is post elections globally, equities rally between 1 and 3 6 months time frame. That's the historical averages. If you write on your screen from 1990 till latest 2020, equities obviously has been the best performing asset class, particularly for the next subsequently 6 months time frame. Obviously, currency also takes a beating, which is why USD tends to do better compared to JPY. Overall perspective, but if you look at from a bond point of view, the bond markets tend to sort of rally further on anticipation of a inflationary policy, or policy that will drive more growth in the US markets. So that's a very quick backdrop on what's happening globally. Coming to next slide, what's happening in the Indian context. I think so. One thing is very, very clear that India continues to see a massive amount of inflows, primarily thanks to domestic markets and domestic flows. FII tends to vacate the market, and YTD as it stands today is obviously negative, point to $200 million out to $300 million. This could probably potentially be, the weakest year in the last many years for the FI investment, given so despite such attractiveness on the Indian market. I think one of the main challenges is FI doesn't draw a lot of comfort on the kind of valuations that the Indian market commands, and also alternative of Indian markets, which is global, China, Vietnam, and Taiwan. Having said that, in the domestic market, $75 billion of total inflows by the domestic remains a very, very tall ask, which I think which has been a fantastic inflows for the market to sort of thrive and grow. At the similar time, there has been a series of, let's say, follow on or public IPOs that is sucking out the liquidity from the market. To our sense, this particular additional liquidity will obviously get a little dried out thanks to the FII selling and the domestic large amount of secondary market offerings. Which is why it will be very, very important that which companies that will drive growth will be the most important sort of matrices to invest with, and most sort of importantly, the broader market or the longer tail market of invest and you could make a lot of money anywhere will be behind with complete bottom up research, and stock selection market will take center stage. With that, moving to next, moving on to the next slide. When you look at what's happened in the earnings so far, and I was saying that earnings season has been a little soft this particular quarter. Oil and gas, metals, power, and construction have seen a very, very bad number so far, deep in the red in terms of growth. More importantly, only telecom and cap goods, to some extent services, have done good performance from a YY growth point of view. But more importantly, when you look at the overall earnings growth profile, two-thirds of the businesses in the country have either met or missed expectations in this particular quarter. Also, all the eyes are on the upcoming festive season because that's going to be the big, make or break for the earnings season for the year. At the beginning of the year, when we started, we eyed our most consensus believe that the Nifty will grow between 13 to 14% earning growth. As we speak, at the end of the Q2, the growth expectations have been tapered to low high to single digit at between 8 to 9%. Moving ahead, when we look at what's been the commentary that we're picking up in the earnings season, right from the retail businesses, Retail Association of India obviously has spoken about a strong double-digit growth in the Diwali season, or we speak about discretionary spends, or we talk about the jewelry, or we talk about the Cantable Retail, which is another retail company that is focusing on the men's retail wear. Most of them are are obviously guiding for a strong H2 or a better H2, or even subsequently better festive season. To my mind, the picking up of economy, particularly infrastructure capex being picked up, and also after a lull H1 period because of lower government spending, we will see some sort of spending of H2 being better than the H1. We might see earnings picking up as we move forward. However, the growth will still be in high single digit for the Nifty companies, and the overall growth to our understanding will taper off, and there will be very very select pockets of growth, and bottoms of earning growth. Investing style will make a very sharp comeback, and that's what we are seeing as we speak today. Moving ahead, the valuations remain at around long-term averages for the Nifty. Price to book obviously remains at a premium. Big reason being in the ROE profile. If you look at the ROE profile this particular year, we are sitting at a 12-year high ROE profile. The last time the Nifty delivered exceptional ROE was 20% plus in FY07. Post that, the number has been between low to mid teens. And I think with this kind of capital efficiency improvement, markets from multiple point of view is not expensive, but growth is where everybody will have keeping a close track on. And to our understanding and very very clear outlook, we think earning growth across the spectrum will sort of taper off, but very select pockets and very select companies which have pricing power, which can demonstrate strong execution, and businesses who can withstand this particular slowdown much better in a hyper competitive environment will be the one to bet on, and that's why the stock picker market will come at the center stage as we speak moving forward.